Hi, this is Chris O'Shea, Chief Investment Officer here at the Financial Consulate. It's Monday, the 24th, a little after 12 o'clock, and we wanted to reach out to communicate thoughts relative to the S&P crossing over into 10% correction, 10% downturn. That's the official territory that market observers like to recognize. And so the most recent low had been in October. So it took 3 months until January the 4th to come to a new high, January the 4th. And since then, it only took 12 trading sessions to reach the low 10% correction. And so it does it always in a much faster way than the upturn. And that's unnerving to folks. But on the other hand, it is a healthy activity because it takes some of that exuberance about the market out. Markets typically climb the wall of worry, as they say. And so since the bottom of the pandemic in March 23rd of 2020, the market is up over 220%. Even from the month prior to that, February 19th of 2020, the market's up 42%. So the market is overdue for a correction such as this. I mean, for some stocks such as Amazon, they peaked in July. Some parts of the tech sector in February of last year. Remember, February of 2021, interest rates also went up significantly. From the 10-year was up from 0.9% to 1. Basically where it is now, 1.7 some percent. And so obviously they got a lot of people's attention. And so what's happening? Well, the Federal Reserve last hiked rates 3.5 years ago. Really, so in December of 18, they announced that they were not going to be hiking rates anymore. So it's been 3 years since then, and markets trying to figure out what's going on with the Federal Reserve, with inflation, but market downturns always come with uncertainty. And so we just continue to tend to our knitting, as it were, where time in the market is better than trying to time markets. We do things like look for opportunities to take some losses in taxable accounts in times such as this. We also always consider things of rebalancing. In early part of January this year, around the time the market was peaking, we had planned to for people that were less than fully stocks, that they were taking some money off the table. We rebalanced into more bonds since then. Bonds are down this year also, but not as much as stocks. So there's always opportunities in the future to rebalance back in. So our fixed income managers have been shifting the portfolios into things that would do better in rising rate markets for some time. As far as inflation, the 10-year bond right now is trading 1.7%. Inflation is raging at 3-4 times that number. And so markets right now don't believe that the inflation will continue beyond, into 2023. And so obviously the global lockdown and the supply issues, since then reopening, things are still trying to normalize. People have pointed back to World War II when the war effort was rationing many things that people needed or wanted. And so when the war ended, people's demands for certain things skyrocketed. Interest rates did not, but inflation did. And so for inflation to get embedded back into the psyche as it did in the 70s, it would have to, a lot of things would have to change from here. Right now, we are seeing short-term spikes continuing in certain areas. And so, but in some areas, they've come off the boil, as it were. So yes, markets are turbulent. We expect more volatility. I mean, the Federal Reserve has gone from this easy stance, in fact, the unprecedented ways of injecting money into the market during the pandemic. That's almost 2 years ago now since that was done. Market is trying to reprice. It's trying to figure out a lot of things right now. And so that's a healthy thing for markets to do. We continue to look at the long-term horizon, look for opportunities, look for things both on fixed income and the overriding word that we're encouraging people is patience right now. We have managers that we trust, managers that don't get spooked by markets, that continue to do what they do. Markets right now are just not the things that we hold are out of favor. And there are times when markets will do that. But the longer term things, we like the things that we own. We like them for the long term. And so we encourage you, if you have any questions, you talk to your relationship manager, but continue to look to the long term. People who are taking money out of portfolios, we always have the bonds to draw from. In fact, those people who are more heavily in stocks, we've already started to take money out of the fixed income side, like we have said, in order to leave stocks alone. We don't have to sell stocks when they're down. So we'll continue to tend to portfolio management. So that's it for today. We look forward to seeing you in the future. Thank you.